Hello and welcome. Today we are talking directly to retirees and those who are getting close to retirement because something very important has changed and it could have a major impact on your income, your taxes, your Medicare premiums, and even your long-term financial security. The new required minimum distribution rules under Secure Act 2.0 have officially changed the retirement landscape, and if you have a traditional IRA, a 401k, a rollover IRA, or most other tax-deferred retirement accounts, this update directly affects you. These changes are not small technical adjustments. They affect the age when you must start withdrawing money, the penalties if you make a mistake, and the long-term tax strategy that many retirees rely on. On top of that, there are ongoing updates involving stimulus relief, pensions, and government benefits for seniors that interact with these RMD rules in ways many people do not fully understand. This is not something to ignore or postpone. It is something you need to understand clearly so you can protect your retirement. Required minimum distributions, commonly known as RMDs, are mandatory withdrawals that the federal government requires you to take from certain retirement accounts once you reach a specific age. These rules apply primarily to traditional IRAs, SEP IRAs, simple IRAs, and employer-sponsored plans such as 401ks and 403bs. The reason RMDs exist is simple. When you contributed to these accounts during your working years, you received a tax benefit. You either deducted the contributions from your taxable income or you allowed the money to grow tax-deferred. The government allowed that money to grow without taxing it year after year. Eventually, the government expects to collect taxes on those funds. RMDs are the mechanism that forces that process to begin. For many years, the starting age for RMDs was 70 and a half. That changed under the original Secure Act, which increased the starting age to 72. Now, under Secure Act 2.0, the starting age has increased again. For many retirees, the RMD age is now 73. For younger individuals who were born in 1960 or later, the starting age will eventually move to 75. This means that if you are approaching your early 70s, you must know exactly which rule applies to you. A one-year difference may not sound significant, but in retirement planning, a single year can change your tax picture dramatically. If you turn 73 this year, you are required to begin taking your RMD. The rule allows you to delay your first distribution until April 1st of the year following the year you turn 73. However, delaying can create complications because you would then have to take two RMDs in the same calendar year. That means two separate taxable distributions hitting your income at once. For some retirees, this can push them into a higher tax bracket and increase other costs tied to income, including Medicare premiums. Understanding that timing is critical because a small delay can create an unexpected tax surge. The way the IRS calculates your RMD is based on a formula that considers two main factors. The first factor is the total balance in your retirement account as of December 31st of the previous year. The second factor is your life expectancy, which the IRS estimates using a life expectancy table. The IRS provides a uniform lifetime table that assigns a distribution period based on your age. To calculate your RMD, you divide your account balance by the life expectancy factor assigned to your age. That number becomes the minimum amount you must withdraw for the year. For example, if your traditional IRA was worth $500,000 on December 31st of last year, and the IRS life expectancy factor for your age is 26.5, you would divide 500,000 by 26.5. The result would be approximately $18,868. That is the minimum you must withdraw for the year. You can always withdraw more than the minimum, but you cannot withdraw less. The distribution must occur before the deadline and it must be properly reported. One important detail many retirees overlook is that each retirement account has its own RMD calculation. If you have multiple traditional IRAs, you must calculate the RMD for each one separately. However, you are allowed to combine the total and withdraw the combined amount from one or more of the IRAs. That flexibility does not apply in the same way to employer plans like 401ks. If you have multiple 401k accounts, you generally must take the RMD from each separate account unless certain consolidation steps are taken. Failing to understand that distinction can lead to accidental underwithdrawal. Missing an RMD can be very costly. Under previous rules, the penalty for failing to take your full required minimum distribution was 50% of the amount you failed to withdraw. That penalty was one of the harshest in the entire tax code. Under Secure Act 2.0, the penalty has been reduced to 25%. While that is lower than before, it is still significant. If you were supposed to withdraw $20,000 and you did not, the penalty could be $5,000. In certain cases, if the error is corrected quickly, the penalty may be reduced further to 10%. However, that still represents a substantial cost. The safest approach is to avoid the mistake entirely. Beyond the direct penalty, RMDs create a larger issue that many financial advisors refer to as the RMD tax time bomb. During your working years, you likely contributed to tax-deferred accounts because it reduced your taxable income at the time. Over decades, those accounts may have grown significantly. If you allowed them to grow without withdrawals, by the time you reach your early 70s, the balances can be very large. Once RMDs begin, the required withdrawals can also be large. Because these distributions are taxed as ordinary income, they are added to your other sources of income, including Social Security benefits, pensions, rental income, or part-time work. The combined total can push you into a higher tax bracket. When your income increases, other financial consequences follow. One major area affected by higher income is Medicare premiums. Medicare Part B and Part D premiums are income-based for higher earners. This system is known as IRMA, which stands for Income-Related Monthly Adjustment Amount. If your income exceeds certain thresholds, your Medicare premiums increase significantly. A large RMD can push your income above those thresholds, triggering higher premiums for the following year. Many retirees are surprised to see their Medicare costs increase, not realizing that the RMD from 2 years prior is the reason. Another effect of higher income is the taxation of Social Security benefits. Depending on your total income, up to 85% of your Social Security benefits can become taxable. When an RMD increases your income, it may cause more of your Social Security to be subject to federal income tax. This layering effect can create what feels like a chain reaction. The RMD increases income, the higher income increases taxes, and the increased income also raises Medicare premiums. That is why planning before RMD age is so important. Now let us talk about smart planning strategies that can help reduce the impact of RMDs. One of the most widely discussed strategies is the Roth conversion. A Roth conversion involves moving money from a traditional IRA into a Roth IRA. When you convert, you pay income tax on the amount converted in the year of the conversion. However, once the money is inside the Roth IRA, it grows tax-free, and there are no RMDs during your lifetime. This can significantly reduce the size of future RMDs from your traditional accounts. The ideal time to consider Roth conversions is often in the years between retirement and the start of RMDs. For example, if you retire at 65 and do not begin RMDs until 73 or later, you may have several years when your taxable income is lower. During those years, you can convert portions of your traditional IRA to a Roth IRA, filling up lower tax brackets deliberately. Instead of waiting until RMDs force large taxable withdrawals, you spread the tax cost out over several years in a controlled manner. Another important strategy for charitably inclined retirees is the qualified charitable distribution, commonly called a QCD. Once you reach age 70 and a half, you are allowed to transfer up to a certain annual limit directly from your IRA to a qualified charity. That distribution counts toward your RMD but is not included in your taxable income. This is powerful because it reduces your adjusted gross income, which in turn may help keep Medicare premiums lower and reduce the taxation of Social Security benefits. The key requirement is that the funds must go directly from the IRA custodian to the charity. If you withdraw the money first and then donate it, the tax benefit is lost. In addition to RMD rule changes, retirees are closely watching developments involving stimulus payments, pensions, and government benefits. In recent years, there were several rounds of federal stimulus payments aimed at providing economic relief. While there are currently no broad nationwide stimulus checks being automatically issued in the same way as during the height of the pandemic, certain state-level relief programs and targeted assistance initiatives continue to appear. These programs may be based on income, age, property taxes, or other eligibility factors. Retirees should remain attentive to official announcements from their state governments because some relief programs are specifically designed for seniors on fixed incomes. Pension income remains a critical piece of retirement security for many Americans. Defined benefit pensions provide predictable monthly income, which can help offset the impact of RMDs. However, pension income is generally taxable at the federal level, and in some states it may also be subject to state income tax. When pension payments are combined with RMDs and Social Security benefits, the total income picture becomes more complex. Careful planning helps ensure that required withdrawals do not unintentionally push retirees into higher tax brackets. Social Security benefits have also been adjusted in recent years through cost of living adjustments. These increases help retirees keep up with inflation, but they also increase taxable income for some individuals. When Social Security benefits rise and RMDs begin at the same time, retirees may notice a meaningful increase in their total reported income. Understanding how these different income sources interact is essential for long-term financial stability. It is also important to understand how inherited retirement accounts are treated under the new rules. If you inherit a traditional IRA from someone other than your spouse, the Secure Act introduced a 10-year rule for many beneficiaries. Instead of stretching distributions over your lifetime, you may be required to withdraw the entire balance within 10 years. Depending on how those withdrawals are structured, they can create significant tax obligations. While this primarily affects beneficiaries, it also influences estate planning decisions for retirees who want to pass assets to their children or grandchildren. For retirees who are still working past age 73, there may be an exception to RMD requirements for current employer plans if they do not own more than a small percentage of the company. In such cases, RMDs from the current employer's 401k may be delayed until retirement. However, this exception does not apply to traditional IRAs. That distinction is crucial for individuals who continue working into their 70s. Another area that deserves attention is withholding and estimated taxes. When you take your RMD, you have the option to withhold federal income taxes directly from the distribution. This can simplify tax planning because the withheld amount is treated as if it were paid evenly throughout the year. For retirees who do not have other withholding sources, such as wages, using RMD withholding can help avoid underpayment penalties. Planning the withholding amount carefully ensures that you do not owe a large tax bill at filing time. Inflation has also changed the retirement environment. Higher living costs mean retirees may need to withdraw more from their accounts to cover expenses. If RMDs coincide with market downturns, retirees may be forced to withdraw funds when account values are temporarily depressed. This sequence of returns risk can erode long-term portfolio value. Diversification and careful withdrawal strategies can help manage this risk. But understanding that RMDs are mandatory regardless of market conditions is important. State taxes add another layer of complexity. Some states do not tax retirement income, while others tax it fully or partially. Moving from one state to another during retirement can change your tax exposure significantly. RMD planning should consider both federal and state tax consequences to avoid unpleasant surprises. As retirees look ahead, the key message is preparation. RMDs are not a surprise rule. They are predictable, formula-based, and clearly defined. The shock comes when retirees reach the required age without having prepared for the tax impact. Taking time in your 60s and early 70s to project future RMD amounts can reveal whether proactive steps are needed. Financial literacy in retirement is not about complex investment theories. It is about understanding how income flows affect taxes, healthcare costs, and long-term security. Required minimum distributions are a central part of that equation. The recent rule changes under Secure Act 2.0 have given retirees slightly more time before mandatory withdrawals begin, and they have reduced penalties for mistakes. However, they have also highlighted the importance of planning earlier and more strategically. The combination of RMDs, Social Security, pensions, Medicare premiums, and potential state benefits creates a layered financial structure. Each layer interacts with the others. A decision in one area can influence costs in another. Retirees who take the time to understand these connections are far better positioned to maintain control over their finances. As you move forward, remember that RMDs are not simply withdrawals. They are taxable events that influence your broader financial picture. The new starting ages of 73 and eventually 75 provide opportunities for earlier planning. The penalty reduction to 25% still demands careful compliance. Strategies such as Roth conversions and qualified charitable distributions can significantly reduce long-term tax exposure when implemented thoughtfully. Retirement should be a period of stability and confidence, not confusion and unexpected tax bills. By understanding how required minimum distributions work, how they are calculated, how they affect Medicare and Social Security, and how recent legislative changes have reshaped the rules, you empower yourself to make informed decisions. Staying informed about developments in stimulus programs, pensions, and senior benefits ensures that you do not miss valuable opportunities for relief or support. The most important takeaway is that preparation changes outcomes. When you understand the rules before they affect you, you have options. When you wait until the year the distribution is due, your flexibility is limited. Knowledge allows you to act deliberately instead of reactively. That is why these new RMD rules matter so much, and that is why retirees truly need to see and understand these changes now.